Hello, and welcome back to my channel. I am Christy Vann, and on this channel, I teach velocity banking. My idea is just to get you guys educated. That's all the channel is for, is to get you educated. Because if you don't know that you don't know, then you don't know what your options are. And with the channel and the options that I show on here, you should be able to get out of debt with no problem. We are in a cycle, okay? You are not stupid. You're in survival mode. And when you're in survival mode, your brain won't even process correctly. Do you know that when you're worried, frustrated, that your brain is only using so much? I mean, you're not able to process. Why are you not able to process? Because you are exhausted. Your brain is exhausted trying to figure out what you're going to do. So when we're in survival mode, our thought process is not working correctly. It's just as if you had 24 hours with no sleep. Isn't that amazing? Doesn't that make you think that maybe it's not your fault? Maybe this cycle is wearing you out and you're paying, the poverty penalty. Did you know there's a poverty penalty for being low income or for being in debt? The poverty penalty goes all the way from, the extra price that you're paying, the higher price for things that you're not buying in bulk, all the way to those bank fees that they charge you if you have an overdraft or maybe a returned item. Those fees, they just keep building up. And what about your late fees, right? Late for that credit card payment? Wow, watch out, right? And what happens if you go over the limit? You get another fee. Well, doesn't that make all the sense as to why you stay in a broke condition? And you feel like that you're finally climbing your way up out of the pits of hell with debt, and then something else hits you. You've got to get your tires replaced. The car breaks down. And you fall all the way back down to where you're starting all over again. But it's worse this time because you don't want to try anymore. I'm so exhausted from trying how to figure this out. How am I going to do this? And then you're in worse shape than you were before you started climbing. That's what I don't want to see happen. I went through that. I went through that for years and years and years. 18 years of my adult life. The first 18, that was nothing but stress. Not just financially, but I had marital problems, marital stress. So the idea here is to get your financial stressors out of the way so that you can think about your future. Think about what you need to do to set yourself up financially. It's super sad when I think about what people are going through out there to think that they're in the shape that I used to be. That's super sad to me. And I just really want to help you to avoid the pitfalls. I want to show you options that I didn't know that were even out there. But they are. And if I can get you out of the cycle, the system cycle, then I know that your life is going to be better. Okay, so I am going to be bringing in Don Daniel. He's going to be coming on here talking to us about that 40-year mortgage, what that looks like, what it does to you financially, And we're going to discuss credit cards a little bit as well. So if you all have any questions while we're on here today, feel free to ask in the chat. I'm going to be watching. But I just feel like that if we can get you educated, then you're going to know what's going on with your finances and you're going to be able to figure this out. Hello, hello, Don. Can you hear me okay?
I can hear you just fine, Christy.
Okay, good, good. All right, so we've got everybody in here. They're ready to learn something new, and you're the one to teach them.
All right. Well, I tell you, we talked about this earlier at one time about 40-year mortgages. And what we found out over the years, Christy, is that people have they may get in trouble with their finances, and to save their house, somebody comes along and says, "We can modify your mortgage."
Mm,
Okay? And in modifying the mortgage, and they get a new lower payment and they're able to save their house. But they don't realize that they're in a 40-year mortgage.
yes, I've
Okay.
run into that a lot.
Okay.
Yes.
Now, I'm going to say something that may be a little off-putting, but if I had my way, everyone would have a 40-year mortgage.
Well, I know what you mean by that, but there's probably some people out there that don't.
Okay, so let's go over. Let me start out this way. Okay, I'm going to share something on my screen. Okay, and let me see here. I need to go to screen number 3. There we go. All right, and you should be able to see the amortization calculator.
Yes, I can see it.
All right, so what we're going to do is instead of going straight to a 40-year mortgage, let's do this. I'm going to, let's see, we're going to do this and then duplicate this tab. Okay. All right. So here's what we're going to do. And I want to show why the 40-year mortgage does what it does. So let's just say we started out at um, like $320,000. Okay. I'm
Okay.
trying. And let me see here. We've got something is going on that's not letting me do what I need to do here. Oh, there it is. Okay. All right. 320. And it's a 30, and actually we're dealing with a 30-year mortgage at first.
Okay.
All right. And at 6%. And 5 years in, okay, at 60 months, they run into some trouble. Okay. So they're here. Now on this mortgage, in 5 years, they paid this mortgage down by $22,222.25, $22,225.93. But look how much interest they paid.
Mm-hmm.
Okay. This is what we're fighting against. So if they get let's say they run into trouble and then they get this loan modified. Okay. So they are now working with a loan that's 297,000. Okay. $774.07. But when people refinance a mortgage or when they get um, a modification, it is not the lower interest rate that makes the difference in the payment. If you refinance a loan, it is refinancing it and they're dividing it by a new 360 payments. That is the driving force that lowers the payment. The interest rate doesn't lower the payment that much. Okay.
Yeah.
It is dividing it by, okay. So we're going to put into our new program here. Okay. Let's see if we can get that copied and put it into a new program. and paste that. Okay. Now, if you're using Brett Whistle, you got to take the commas out because Brett Whistle doesn't like commas. All right. And so we have the same, we're going to do with the same 6%. All right. We're going to take this out. So I want to compare the two. We got 297,000. Okay. We have 427.55 going to um, principal and 1491 going to interest. But when we do our new loan, okay, this is our payment, 1638.
Mm,
Okay. So that's what drives the payment down. 1638 as opposed to um as opposed to 1918. Now this is why I like a 40-year mortgage. So if you have a modification and you find out there's a 40-year loan, don't get distressed. 40-year loans actually can pay off cheaper and faster. Let me show you what's going on here. So on the 30-year loan, okay, 5 years in, if you were to prepay the $427.55 before it's due, you don't have to pay the interest on that line and you knock off one payment. Okay?
mm.
Now, if you have this loan now, it only takes $150 to eliminate one payment.
Wow.
Okay. Let me start over again. So let's do this for everyone who has not seen any of my videos. We're going to start at payment number one here on the 30-year loan. Okay. Now, if you make your payment on the 30-year loan, this is January's payment. February's principal payment would be $320.15. If we make January's payment and we want to prepay $320.15, we can knock out this $1,598.41 in interest we never pay. We are already paid down to line two in January. That makes this line three the new February payment. So the payment moves up one. We get rid of line two for just $320.15. If we were to make January's payment and then prepay the principal on line two, line three, and line four, that's a little over $900. We get rid of the interest on line two, three, and four. And our next payment is on line five. So payment number one is now touching payment number five. That's how prepayment works. Most people are unaware that how much interest can be eliminated through prepayment. If we take a look at the first year on here and all the principal payments for 1 year, it comes to 39.29.62. But look how much interest they want us to pay to get this much equity. That's what's hard to look at. But
Hmm.
if I had if I had the money to work with, I could prepay the 39.29 in on line one, be paid down to line 12 in 1 month, and eliminate all the interest between line two and line 12. That's $17,511.07 of interest I'll never have to pay to get to the very same place, and I'll only pay $1,600 in interest to get to here. And then my next mortgage payment would be here on line 13. Now, why did I show you that? Now, it looks amazing to be able to do that with $320. But on a 40-year loan, now I'm dealing with $150 going to principal. It gives me more leverage. Leverage means I put in a small amount of effort and I get a big benefit for that effort. If can you imagine a pulley system, Christy? I got a pulley
Yes.
system, And if I have the right pulley system, a 12-year-old girl can lift an engine block with the right pulley system.
Right.
It's the mechanical leverage. So I want to put a small amount of effort into eliminating something that's large. So if I can prepay a small amount to get rid of the interest, to get rid of one line on my mortgage, I can prepay $1,800 here and get rid of one whole year, as opposed to,
Isn't that crazy?
but if you know how amortization works, that's why most people run into trouble because we've never been taught how to read an amortization schedule. So if you're using something like Money Max, for instance, who can take the Money Max when you feed all the information into Money Max, so it will look at what is the smallest amount of money that you have available at any given time to put on debt that will maximize the amount of interest I can eliminate per dollar.
Okay, so I want to go back here a
Yes.
second because I don't think that people grabbed what just happened.
Okay.
Because it's hard. If it's hard for me after all these years and I look at this, daily,
Hmm.
if it's hard for me to take this in, then I know people watching are like, what just happened?
Yes.
Okay, so you were talking about taking basically a refinance,
Right.
remodification, they do
Hmm.
into 40 years sometimes.
Yes.
So when you're talking about that,
Hmm.
you showed in the 30 year, and
Yep.
we're talking about principal only payment.
Right. Principal.
$318.50 for your first month's payment is principal only.
Right.
Okay. Out of $1,900. Okay.
Mhm.
This is not baby numbers here. This is
No.
$1,900 a month.
Right. So yeah, it's
Right.
1918. Yep.
Right.
$1,900 a month. Yes.
So the 300 now go back to the 40 year,
Okay. The 40 year.
and now you're at $150 basically for
Hmm.
principal.
Yep.
And you basically have, so, okay, so let me just say this
Okay.
because this is overwhelming to the mind
Hmm.
that this is happening.
Okay.
But they are literally gaining the same interest basically that they were in the 30-year mortgage,
Yep.
but your payment on the principal part is cut in half,
Yes.
basically.
Yes.
So you're still paying them the same interest.
Hmm.
It's just that the reason the payment lowered is because you're basically paying less to
Yeah. To
your
your,
actual balance.
yeah, to your
Yeah.
side of the thing. Yes.
Wow.
So, Christy, what we need to understand is anytime I lower the interest rate or I lower the term, I go from 30 years to 15 years or something like that. I increase the principal payment and it makes it harder to prepay.
Mm-hmm.
I can come up with $150 easier than I can 300 to
Right.
prepay to knock out a whole line. Now, if you thought that was hard to wrap your mind around, I need everybody who's watching here to see this. And I'm in the 70s, and you may remember that your parents or your grandparents may have talked about the fact that in the 70s, interest rates rose to 18%.
Yes.
Do you remember that?
Yes.
Now, you know what's strange about that is your parents and your grandparents actually paid those mortgages off. And
That's correct.
we're struggling with 16%, with 6% or 4% or even 3%. Let me show you why that is. the median home price in the 70s was $70,000. Okay, the median home price. So let me put that in here, 70,000. Okay. So why won't my thing type?
I don't know.
I don't know. 70. I'm trying to put in. All right, let me do this. Okay. Delete. Okay. 70,000. There it is. And we're also going to put in 18%. Okay. For 30 years. Now, because we learn how to read this, when we first see it, it might be shocking. But now that you know what to do, it's not quite so shocking. Here is the payment, $1,054.96. If we look at the summary, here's how much interest the bank wants on this loan. They want $309,785.60 if you keep $70,000 mortgage for 30 years at 18%. So your total interest paid as a percentage of principal is 442%.
Wow.
But when you look at the payment, look at this. Now that you know how to read this, is it distressing?
No, not at
Okay,
all.
not at all. Because I've got $4.96 going to principal. I got $5 going to principal. So if I can come up with an extra $5, Christy, I kill 1,000 over $1,000 worth of interest and I take out one line. Look at this. Add up all the principal for 1 year. $64.67 kills 1 year off this mortgage and kills almost $12,000 worth of interest.
That's crazy.
This is why. Now, am I promoting go out and get an 18% mortgage? No, I am not. But what I'm saying is don't get distressed if you feel your interest rate is high and everybody's looking to get a lower interest rate because that is how we've been oriented.
Right.
But if I can afford the payment, there is no way I'm going to refinance to a lower interest rate. If I can afford the payment at a higher interest rate, there is no way I'm going to buy down. I'm going to use my dollars to buy points to buy down the rate because I'm going to make it harder for me to pay this mortgage. So everybody who's out there who realize that they feel taken advantage of because they got a modification to save the family home and got a 40-year mortgage, we're going to show you using Money Max how you can take advantage of the 40-year mortgage with these smaller principal payments and kill this thing in about 7 years.
That's crazy.
And if listen, if you want to know how you can get um, a savings and earnings report, you can go to pillmethod.com and get a free savings report. And we'll make sure that we'll show you how Money Max can help you in any situation that you're in. So it is, are there, I can't see any, if we have any questions, Christy, about
Uh,
this.
no, they're just saying, wow, that's amazing. They just love what you're talking about.
Okay.
So yeah.
So now, some people have talked about credit cards as well. All right, credit card debt. And do you know how many people I run into that says, I have never paid any credit card interest, and they're quite proud of that fact. Okay? Never paid
Yeah.
any credit card interest. I pay my credit cards off each and every month. If you are using any system that says, okay, like the snowball method or the avalanche method. Now, the avalanche method says that we're going to, if we're attacking the debt, we're going to attack the higher interest rates first, and then as we pay those off, we'll take those minimum payments and then add them into the next debt. Okay? Can I show you something that's quite interesting? So let's go back to this 30-year loan. Okay? And I'm going to change what we have over. I hope everybody enjoyed this one on the 18% because I'm
Yeah,
getting ready.
definitely.
I'm getting
And
ready to change
Don,
that.
Don, they want to know if you work in Canada.
Yes.
Okay.
It's the name of our business is Pill Method International.
Oh, okay.
In fact, on the way to my studio today, Christy, someone who saw the video from 2 weeks ago,
Uh-huh.
okay, called me from the UK. I was talking to her while I'm on the way here. She says,
Wow.
I saw you on Christy Vann's YouTube channel, and she's calling from the UK, and she now wants to know how the Money Max can help her with her two mortgages.
That's awesome. I
So,
mean, the UK, I get them a lot. Canadians in UK
yep.
seems to be really watching the channel.
All right. So we're going to put in $10,000, okay, at 27%. All right. Let me put the rest of the zeros in here. Okay. Now, everybody, all the experts are saying at 27%, this $10,000 is killing you. Now, if you use Brett Whistle like I do, if you're putting in a credit card, you need to put in 240 months. All credit cards are amortized over 240 months. Okay? So they're telling you to pay off this $10,000. Now, if I put $10,000 on my credit card, Christy, and if I pay it off before it's due, do I owe any interest? I'm asking, I'm
Oh,
hoping, I'm hoping some of your people would say, put an
well, I
answer
was
in.
looking in the chat
Okay.
and no,
No, exactly. So I would not have to pay the interest that would be due, would I?
no.
So let's take a look at what interest, okay? We're going to scroll down and, uh-oh, I've got 100,000. I got one more zero in here that I need. Okay, let's do this again. All right, there we go. Let's scroll down and take a look at the interest only payment. At $10,000 at 27%, which feels really bad. If I pay that all off now, I save $225 that I don't have to pay Visa.
Okay.
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 Well, or if I have this 300,000, $320,000 mortgage at 6%, I may say, Visa, I'm thinking about paying you the $225 and taking that $10,000 and put it on this mortgage instead and knock off 30 months
Wow.
and save $45,000 in interest. Why are the experts telling us if we have other debt, why aren't the experts telling you and me that we need to look at interest cost instead of just interest rate and make better decisions about our money so that when we start to pay down debt, our dollars will do more work for us, eliminating interest?
Isn't that amazing? Wow.
Well,
See,
see,
you really sit down and educate people on what's going on, that they're in the hole.
yeah,
I mean, if we just would follow these guidelines, we're going to, definitely have less time in whatever debt we have. That's the point.
yeah.
The idea is to stop the interest.
We're all looking at how fast to pay off the debt.
Right.
Fast, if we do stuff fast, it chances are it will not be cheap. We're going to end up paying more interest using the snowball method, using the avalanche method. We may be out of debt faster than if we did nothing, but we don't know how much extra interest we're paying because those methodologies, they do not pay attention to interest cost. Whenever
Right.
you do something, you want to be able to say, this is how much interest I'm saving when I do XYZ.
Mm-hmm.
Okay. And then if
Okay.
I'm doing this or that, then I want to be able to compare. It's called opportunity cost calculation. If I do this with my money, I can't also do that with my money. So am I losing or am I gaining by choosing A or B? So when it comes to paying off debt, when it comes to getting out of debt, the more interest you pay, the longer you stay in debt. I don't care how you pay off the debt. I've told this story before about a gentleman who gave me a call who took $40,000 out of the bank, paid off his car, and saved about $6,000 worth of interest.
Wow.
So he could take his $600 he's no longer paying on the car to put it on the mortgage every month
Mm-hmm.
because
Mm-hmm.
that is snowball methodology.
Right. Yes.
Well, that you can only spend that $40,000 one time. He has to get a
Mm-hmm.
new $40,000 now. But if he had put it on his mortgage, even on this mortgage, his mortgage was 700,000, not 320,000. Okay? But even
Wow.
on this mortgage, $40,000 would do this. Knock off 98 payments and save $146,000 in interest.
Wow.
We're not taught that. What we're
Right.
ta- what we begin to believe is that anything we do to get out of debt is almost as good as any other thing we do to get out of debt. And when you understand an amortization schedule, you can literally set up the money max to um, to optimize itself so that you can save even more money if you know how to read an amortization schedule. I have the pleasure, Christy, of talking to some of your clients who already own Money Max. And in talking with them for just a half hour, just the other day, I saved one young lady an extra $10,000 in interest she won't have to pay
Wow.
and reduce how much time she has. I can't remember how many years, maybe it's 1 or 2 years. On average, we save at least 1 or 2 years and 30 to $40,000 in interest off of what they're already doing
Wow.
because we set it up differently so that the program can work more efficiently in paying off the higher. So the longer you wait,
Help this. Sorry.
yeah, I was just saying the longer you wait to apply money to principal, you don't get a chance to kill these larger interest payments.
Right.
Okay. So you want to set the program up so it starts putting money on debt sooner as opposed to later.
Right. So let me ask you something before you go on. And I don't know if the people can see us right now. They're looking at your amortization schedule, I think.
Okay.
Um,
They can see us in
but
the corner.
all right. So
I can take it off the screen.
no, that's okay.
Okay.
If you're going to use it for sure.
Yeah.
I don't think that people, I know I didn't
Hmm.
understand what you've been talking about here. And I think that that's why the people watching right now are so amazed at what they're watching because it's not taught. It's not
No,
taught.
anywhere.
So when you're doing a refinance, you
Mhm.
showed the amount that they were going to refinance, but am I wrong in thinking that they're going to have the origination fees and all that added back into that loan as well?
Well, listen, you are exactly right.
Yeah,
So
that's
if
what I
we
thought.
if we refinance this loan, okay? Let's say
Mm-hmm.
this loan we're in 5 years, okay? So I already have the numbers set up, okay? I've got this one at 6%, okay? At
Mm-hmm.
320. I put in over here, we're going to refinance this loan, not for 40 years, but for most people who get this loan, they'll refinance it for 60 months, for 360 months
Right.
or or 30 years. Let's just say they had an opportunity to refinance into a 4% loan. Okay.
Okay.
So they had this loan for 5 years. Okay. And this is how much they owe after 5 years.
Mm-hmm.
And the average closing costs on that, let's say, well, let's call it about $10,000. So instead of 297,000, they add 10,000. So now we have 307,000, correct?
Right.
Okay. 307. Okay. And this would be our new payment. We were at 16. Okay, that was, let's see. We were at 1918, okay?
Mhm.
And we're going to be feel much better when we refinance this thing at 4%, but for 360 months, this is my new payment. It's 1469.36, so I feel much better.
Mm-hmm.
But look at my principal payment. Now, how much do I have to come up with to kill one line?
Wow.
449 $444.92. So
That's amazing.
we just now when I do one of my videos, and on my channel, the YouTube channel, okay, on the Pill Method YouTube channel, I point out that people often find themselves paying 200 to 300% on a refinance, and these are people with perfect credit. How is that possible? So remember, we have to pay off the $10,000 to get down to our original 297,000, correct?
Wow.
Because we
Yes.
just we just added $10,000 on.
Mm-hmm.
So let's pay off the first 10,000. That's the see, we put a loan within a loan.
Right.
$10,000 at 4% can't be that much.
Yeah, right.
Okay? So in the first year, have we paid off any of the mortgage, or are we just paying off the $10,000 we added to
Yes.
it? So
Yes.
$5,400 of the $10,000 fee to get the refinance, we've just paid off in the first year. How much interest have we paid on that?
Wow.
By the
Oh,
time we pay down the $10,000, it takes 22 months
oh my goodness.
and $22,000. So let me ask you this.
Wow.
If you're now, most people would jump on this. If I could get a 4% from a 6%, I'll jump on that with both feet. But let me
And they're
ask you,
doing it right now. They're
yeah,
doing it right now, and they're not even down to 4%. They're
yeah,
down to what, from a 7 to 6.2 right now?
exactly. So
Wow.
what if your credit union sent you a notice saying, listen, we'll lend you $10,000 for 22 months, and all you have to pay us is $22,000 in interest? Everybody would say no. Everybody would
Yeah.
say no. But they're able to hide it in this mortgage like this. So, Christy, if you borrowed $5 from me and I said, pay me back the $5 tomorrow, Christy, I know you left your wallet at home, no problem. Borrow five,
Hmm.
but give me $5 in interest on that. What interest rate am I asking for? Isn't that
That's
100%?
crazy.
$5, pay me back my $5 and $5 interest, that's 100%. So
Right.
if I borrow $10,000 from the bank and pay them $10,000 in interest on that $10,000, isn't that 100%?
Yes.
What if it's $20,000?
Oh my
Isn't
goodness.
that 200% hidden in this loan for a person with perfect credit?
I'm in pain. I don't know if the other people watching are in pain, but I'm in pain
They,
because this is the problem. This is the cycle right here.
yes. So, how much did this refinance actually cost? $32,000. And now I'm back to my $297,
Wow.
$297,000 I had, but I'm $32,000 poorer to get
Yeah.
this.
Yes. Oh my goodness. Yes, that's the point.
Plus, I
Oh,
made it harder to prepay to save money
right.
all the way around.
Isn't that just super sad? And people are out there thinking they're doing the right thing by one, making their monthly payments,
Yes.
but by two, by refinancing. They really think, oh, this is the way we're going to win. This is it. I've been there. I've done it. I know. I know.
Christy,
Oh
I've
my
done it.
goodness.
I've refinanced before.
Yeah.
Oh, because, we've had a house 20 years ago before I started this business, and we refinanced to a lower interest rate, thinking that was the thing to do because we've been told if you can save 2 points, refinance.
Yeah.
And I didn't even realize I was getting a new 30-year loan.
My poor grandmother, when I think back about her, I don't know how many times she refinanced her home,
Hmm.
but every time I think they would send her a letter, oh, we're going to give you $10,000 of equity if you'll
Hmm.
refinance this loan. And having no idea, no idea that she was paying at least 32,000 for that 10,000 they were giving her.
My goodness.
This is why the cash out refi, when I hear that, my teeth literally go on edge and I grit, is because people don't realize that they could have, I mean, even if you don't use the money max, you could go to a bank and get a HELOC for that
Yes.
same 10,000
Yes.
and not have a fifth of the interest that you're
Exactly.
going to be paying on a mortgage. It's unbelievable just how messed up everything is. Oh,
For everybody who follows you, Christine, that gets a HELOC and they're afraid of a variable rate. Don't be.
yes, I know.
Don't be. And listen, folks, don't lock the rate. If a bank offers something, just know that they're going to make money from it. A bank doesn't offer you something to save you money. They offer
Right.
something to you so that they can make money. All right? So, if you are using anything that Christy has taught you to pay down your HELOC, you're going to be paying it down faster anyway. Okay.
Mm-hmm.
If you get the money max, you're going to do it even cheaper and faster. All right. But listen, if if I'm bringing my balance down, okay, 5 times the regular rate, and the interest rate goes up, do I really care? Because my
No.
payment is going to be less anyhow.
Oh my
Because
goodness, you
because
wouldn't believe how many times in a day I get that in the comments on the YouTube channel, of course, and I
yes,
hear that. People email me, why in the world would I trade a 4.5% mortgage interest rate for an 8% line of credit? And at this point, I just laugh in not a sarcastic laugh, but
yeah,
a wow, that's just so ridiculous laugh that people just have no idea what the bank, how they charge the interest. That's the difference. How
it
they're charging.
it makes money, and we need to know how the math works. Once we know how the math works, you don't even have to be strong in math
Right.
to
No.
look at this thing to get what I'm talking about, because anybody could tell the difference between having to prepay $444.92 to get rid of interest than having to pay $300 to get rid of interest or paying $200 to get rid of interest. So your if you want to control the loan, control the principal payment,
Right.
not the interest rate. Control the principal payment controls the loan, and interest payments you can skip don't matter. I don't care what the bank is looking for. What matters is what the bank will actually get. So if you have a smaller principal payment, you can use that to your advantage always. Okay?
Mm-hmm.
So remember, lowering the interest rate increases the principal payment.
Mm-hmm.
Lowering the term. I never get a 15-year mortgage. Okay. Lowering the term increases the principal payment. So
Mm-hmm.
if here's one other situation that's going on right now. The interest rates are coming down, but not by a whole lot. There are still um, builders out there that are offering to buy down your rate.
Right.
Okay. And they say, well, if the builder is buying down my rate, why don't I let them? Here's what I would do if I was in that situation. Number one, if I'm in a situation where I have a 6.9% loan and they're trying to buy it down to like 5.5, okay?
Mm-hmm.
Instead of that, okay, um, why don't I ask you to pay my closing costs instead?
Mm-hmm.
Okay? And then I still have my 12,000 or $15,000 I was going to pay in closing costs. Now I don't have to pay it,
Mm-hmm.
but I have a higher interest rate.
Right.
Okay. But I can afford the payment.
Right.
So I was going to pay my $12,000 in closing costs anyway. So why don't I just put it with my first payment
Exactly.
and knock off almost 3 years?
Wow. See there, people? Oh my goodness, this is such a good information.
So if somebody's going to offer to do something for me that's going to make money for me. And buying down my interest rate actually makes it harder for me to pay the loan off cheaper. So I'll keep my interest rate. You pay my closing costs. I'll take my 12 to $15,000 and do this with it instead. Look at that. Look at this.
Well,
$12,000 saves you $53,000 in interest you won't pay on this loan. And it was the $12,000 you were going to use to pay your closing costs.
right, but look at I ever since you said that about the 10,000,
Yeah.
if they don't pay that down on it, that 12,000,
Hmm.
you're literally paying 54, 55,000
Yes.
just to borrow that 12,000. Isn't that crazy? Oh my
Exactly.
goodness.
Now,
I'm
what if the person says, you know what? I have to refinance because of our situation. There's divorce and that's unfortunate. But
sorry.
now we have to refinance because the couple is splitting up. All
Right.
right. If I have the house, I am not going to pay the refinance fee up front. I will roll it into the loan, but I will pay it off with my first payment.
Exactly. Exactly.
So
Beautiful.
never put a large down payment on a loan. So if you have it, okay, if you have it, I would definitely roll the fee into the loan, but I would pay it off just as soon as possible, so I'm not paying 200% interest on the refinance fee just because of our circumstances. Make the best of the circumstances
Right.
and pay less interest with the money that you have.
Okay, people, did you hear what he just said? And if you've been listening, if you just came in the middle of this, when this uploads to the YouTube, and I'll upload it again, go back and watch the whole video because he leads into what's happening here. And after you've seen just this much of the video or this live now, doesn't it make sense how we always are talking about a 30-year mortgage can be turned into 7, 10 years easily,
Easily.
easily. And I mean, if you're 32 years old and you're buying a home and you realize that by the time you're 40 years old, you could have that loan paid off or almost, depending on, what kind of mortgage you're into. But doesn't that just make you think, what? I mean, I had a 72-year-old woman, Don,
Yes.
um, tell me that she had 32 years left on her 40-year mortgage and she's 72. So common sense tells me she's not going to make it to the payoff date
Mm-mm.
unless she just lives to be a ripe old 100 plus, right?
Right.
Now, why would the bank be allowing a 70-year-old to take a mortgage if there wasn't some way they were going to get their interest in that loan within that first 7 years? Because
Okay.
I mean that makes more sense, people. Doesn't it make more sense what's happening?
Mm-hmm.
So
Well, I
yeah.
tell you, Christy, here's the story I tell to my clients and on my YouTube channel. Here's how it starts out. You have a young couple, all right, and they get a small starter home, and once they have one and a half children, I say a half because they got one in the oven, okay,
Yeah.
they realize our house is too small. So then what do? They get a new house with a new 30-year mortgage after they've been in this one 5 to 7 years.
Oh
Now they get a
goodness.
new 30-year mortgage because their house is too small.
Mm-hmm.
Okay. So now they've got little Bobby and little Sally. All right. And 5 to 7 years later, they realize that interest rates drop and then they
Yeah.
refinance. 5 to 7 years later, they refinance and now they get a brand new 30-year mortgage.
Wow.
So now, 5 to 7 years later, little Bobby and little Sally are getting close to graduating from high school. And they realize, I don't have enough money for them to go to school. So what do? We refinance for a
Right.
new 30-year mortgage. So we've added on at least between 15 and 21 years already
Mm-hmm.
to a 30-year mortgage. All right.
Wow.
And so now, once they graduate, all right, and head off to grad school, mom and dad are empty nesters. So what do? They they downsize at age 55 to a brand new 30-year mortgage.
Yep.
And that is the story. That's how it generally goes. And folks, it's not our fault because that is the system we're bought into, and everybody makes you think that's the thing to do.
Right.
Everybody's doing it. It is not because you weren't paying attention in class. It's because there was no class. There are people right up, listen, there's a guy right up the road from me, an hour and a half away, who beats you up and says, it's your fault that you're in this debt. No, it's not. That's
No.
how we've been oriented.
Right.
And what we don't need to be browbeaten. What we need is education on how it's supposed to work in the first place.
Right. Exactly.
You know?
But I don't think that we're ever going to really see that because, I mean, you're kind of defeating their purpose, right? If you're teaching this,
Yeah.
uh, yeah,
But that's where we are, we are helping people all over the world who are looking for a better way. I know in my new book, um, I am going deeper into how all of this works. And the first, it takes we have, and this is one of the examples, 320, so that 150, 160, okay? To pay off half this loan, let's do a little bit of math, go down to $160,000 left, okay? 160,000. Here we go. There it is. Okay? Right around in here.
mm-hmm,
251 payments later. Okay?
right,
251 payments. So if we put 251, okay, divided by 12, it takes almost 21 years to pay off half a mortgage. This is called the bank's profit zone. We pay off the last half in the last 9 or 10 years. That is the buyer's benefit zone. 9 out of 10 people you know will never make it to the buyer's benefit zone.
Oh, yeah,
So
absolutely.
what we're trying to do, what you're doing, Christy, and what we're doing is accelerating people into the buyer's benefit zone by bypassing and shrinking the bank's profit zone. We're not doing anything with them different from the money that we borrowed. We can't do anything about that. But what we're doing is making sure you don't make 360 payments. By the time it's all over, you want to make about 78 monthly payments. By doing this, giving the bank money when they're not expecting it, making it impossible for them to charge interest. Now, it is not just enough to throw all of your money at the debt. What you want to do is be strategic.
Mm-hmm.
How can we pay in a way that maximizes each dollar so it kills more interest than normal? I don't want to save some interest. I want to save the maximum amount of interest that's mathematically possible. And I'm telling you, the math is so enormous to do that. That's where the money max comes in. So,
Yes.
aren't you going to be going somewhere soon to teaching this money max?
Yeah, so we're going to be in Myrtle Beach in April.
Myrtle Beach?
Mm-hmm.
Okay, that's a resort area.
Oh, yeah, we're going to have, it's going to be a party slash education.
I, I
Yeah, I'm
listen.
excited about that.
I would love to be there for that. But listen, as people learn more about using AI, artificial intelligence, to help make decisions about how much to pay, what month to pay it in, what day of the month to pay it on, so that we can minimize interest cost. It is the minimizing the interest cost that gets you out of debt. You don't need more money to get out of debt. You need to pay less interest. And that
Right.
young person that you talked about, Christy, could get out of debt in about 7 years. That's
Mm-hmm.
just half the story. The other half is they can live well while they're
Oh,
doing it. You don't have to live like a pauper throwing
right.
all of your money at the debt. You want to find the least amount of money to pay at the right time so you do not disrupt your cash flow so that your family is you're not telling your family, well, we can't do travel soccer, we can't do baseball, we can't do ballet, we can't do piano lessons, we can't go on vacation because mommy and daddy are trying to pay off the debt.
Mm-hmm.
What kind of message are you sending little Bobby and Sally about money?
Right.
Okay. But if you can pay off everything in about 7 to 9 years, and you're able to have money to do the things that you like to do. Why? Because you're paying less money in interest to the bank. Now we can do all the things that we love to do because it costs us less to live.
Yes.
The average family pays 35 to 39% of their take home pay on interest.
Yes.
And
That's just the average.
that's just the average. And, and but what if you could pay a lot less?
Yeah.
My goodness, we can be out of
I
debt faster, quicker. It'll be, listen, I love this whole thing that you're doing. The Money Max is great. We love working with the Money Max. We just try, we didn't invent it. We didn't invent the Money Max,
know. Mm-hmm.
but we believe that we make it a whole lot better.
Oh, yeah. And the thing, what you were talking about there about the families that think they have to go without or they have to change up their lifestyle to get out of debt. It's all about where are you putting your money, people? That's
Yeah.
what the channel's talking about every day. is how to place your money in a way that it is going to pay off your debt instead of, just paying interest for the money that you've borrowed. We don't care to pay a little bit of interest. I'm not against the banks as far as, hey, I am borrowing money, so I should have to pay some money for them to allow me to do that, but not at the extent that, a lot of people, a lot of people are just on a ride. And it is a roller coaster when you're dealing with the finances. And guys, you can get down to the nitty gritty with eliminating interest if you're using a software like the P.I.L.L method, like he's talking about here. And you can reach out to him at info@thepillmethod.com. I put that in the chat.
Hmm.
So you're welcome to email him
Yes.
and have this conversation, right? On what
Yes.
your debt looks like in it.
And if
You
you and if
go
you're
ahead.
ready, if you're ready to get a savings and earnings report, if you want to go straight there, you can go to pillmethod.com, click on the button that says get a savings and earnings report, and then you can know the month, day, and year you could be debt free and how much interest you could save. We'll give you a free report on that. Either way, reach out.
That's beautiful. Yes, yes. And what I love about the P.I.L.L method is you guys do individual training. Like you make sure these people know what's going on and how to use that exactly right. And I love that. I love what you do. Guys, I'm telling you, we're talking about something that could save you decades on paying off your debt. He has given so much free information here. Don, I wish you were going to be in Myrtle Beach as well, because this is such a good education that you're teaching the American people, and they deserve to know. And
Well,
if you're outside of the U.S., he works with countries outside of the U.S. So that's an option for people that, maybe not in the states here. So get excited. Get
well,
excited.
Well, Christy,
I
if your fan base, if they're going to show up in Myrtle Beach, and if you reach out and say, Don, we'd like you to come, I'll try to move heaven and earth so I can be there, even if I have to disrupt my schedule.
Well, I tell you what, if our schedule, and I think it's set, is the only problem. Like I
Yeah.
said, if I had thought about this, golly, when did we start this Myrtle Beach thing? I think
Yeah.
right in November is when we
Hmm.
started getting everybody together.
Yeah.
But I tell you what, you're doing a great service and people need to know this. Oh my goodness. That my alarm letting me know that we have got to finish.
Okay.
So, people, like I said, he said that if you're ready with your numbers, you can go to thepillmethod.com and go ahead and fill out, the information to get your one-on-one scheduled. You can write me, vantasticfinances.com/max, and I'll make sure that it gets to him. If you're interested in the April conference, that is vantasticfinances.com/April. I'm making it really easy for you people here. Really easy. And you know what? I love everybody that is attentive to what's going on with their finances. And you are in the elite because you're here right now and you're watching and you're seeking how you can do better with your finances. And when we seek, we find.
That's
So
correct.
you're finding it. This is exciting. I want you guys to be excited about your life, about your debt situation, whatever it is. I just know that where there's a will, there's a way, and you're going to figure this out.
Yes.
And Don, I don't know if I told you or not, but I am releasing an online course. This will be my first one.
Wow.
I'm so excited. You know why I'm so excited?
Why?
I have put this off for 3 years. I literally have just kept putting it off. I'm like, they can watch the videos if they want information. I'm telling everything in the videos. But I had somebody write me again the other day and they said if this was down where we could look at it, follow steps, I would be able to do this. So
Yes.
Finally, I sat down. This whole year has been nothing but creating this online course. And it went from I calculated, I was like, okay, we'll have about five sections
Hmm.
that people to be able to get all the velocity. Do you know it's up to 22? I just keep throwing information. I talk about myself. I talk about my husband. I mean, I've literally put everything in this online course and it's just drawn out. But I tell you what, it's going to be of value. And that's what I absolutely love is giving people value. So
It's like
I
having,
don't
it's
even
going
know.
to be like having Christy Vann right there in your home.
It literally is. It does have the Christie AI information that's in there as well. So it tells every single thing about what I teach, why I teach it, breaking down, things like we've talked here today about. So, people, I'm so excited that you were able to join us today. I will have him back on the channel here very soon because I think he's so educated. He's so educated and he's taught me so much as well. So I hope that you guys have a great rest of your day. Thank you again for coming on today, Don. And I'm just excited to join you again next time. And we're going to learn more. When Don comes back in, he's going to teach us more, and I know it. So
Thank
you
you.
guys have a great rest of your day, and I will